The Travel Hackers Credit Score Bootcamp. This is a shortened version of my full course, Credit Score 101, available on Udemy for free. One of the main earning tactics in travel hacking is applying for elite credit cards that come with high sign-up bonuses. The complex part of travel hacking is actually extracting value from those bonuses, which we'll cover in detail. But in the meantime, since credit card applications and accounts impact your credit score, it's important as a travel hacker to know exactly how your credit score works, and in particular, how new accounts affect your score. And a quick spoiler alert, the old common knowledge that opening up new credit cards always hurts your credit score is actually a myth. Credit scores are complex, but in my experience, and in the experience of people I know, when credit is managed responsibly, opening up new accounts typically causes a temporary drop in your credit score, followed by a recovery. And sometimes your score even improves to higher than where it was before the initial applications. That's happened to me. Let's dive in to learn more. So credit scores are important, more so than you might think. First, and most relevant to travel hacking, a score in a good range or above gives you access to high reward credit cards. And if you know how to earn and use those rewards strategically, you can actually leverage access to these cards into saving thousands of dollars on travel every year for as long as you'd like. And that's one of the biggest components of the earnings part of this travel hacking course. What are some other areas where credit scores are important? Basically, any large financing you enter into. So definitely buying a home. When you apply for a mortgage, your credit score can mean the difference between getting approved or denied and the interest rate you pay. The difference between a mediocre score and a good score can affect your interest rate by a few percent. It doesn't sound like much, but on big financings like a mortgage, that literally can mean thousands of dollars a year, since we're talking loan amounts of $50, $100, or several $100,000. So a good credit score can save you thousands. The same goes for other borrowings like auto loans, although the lender probably will be a little less strict since the borrowing amount won't be as big as with a mortgage, especially if you're buying this 300-year-old open-top car here. One thing you need to consider when travel hacking and applying for credit cards in general is that if you already have a good score and have a large upcoming loan like a mortgage, you need to limit or even completely hold off on opening up new accounts. Banks are strict when assessing people for mortgages, and having recent account inquiries, especially in the last year or two, could possibly affect your chances of approval or the interest rate you pay. Having a good score will most likely mean you'll be approved, but if you have 8 new credit cards opened in the last year, they may hike up your interest rate a little bit. Or a lot. Now that we've seen some of the biggest reasons why credit scores are important, let's take a look at what we'll be learning about them in this quick crash course. First, we'll cover how credit scores work, from the basics to the fine details of the credit score calculation. Then, we'll review how to check your score online for free, using one of my favorite credit score websites, Credit Sesame. We'll also see how one of their features, credit monitoring, is useful for travel hacking purposes. And finally, we'll tie it all together and see how this relates to travel hacking. First, let's cover the basics. What the heck is a credit score anyway? It's really a representation of your personal credit worthiness, in number form. Lenders, like banks, use it to judge the likelihood of whether you'll repay your debts. Your score range is between 300 and 850, with a higher score being better, and it's calculated based on your personal credit history. So that's what a credit score is, but how does it actually work? Credit scores are calculated by the credit bureaus, which are simply agencies created to track personal credit information. Your score is based on your credit history over the last 2 years at least, and in some cases takes into account events from up to 7 years ago or more. And the score model is essentially a formula made up of different components, like payment history or amounts owed. A credit score can be between 300 and 850, but what's the breakdown within that? What's a great score versus a bad one? Credit scores can be classified into 5 different ranges. The top range, which means you have excellent credit, is a score between 740 and 850. Next is a good score, between 700 and 740. Like we said in the course introduction, your score has to be within these 2 ranges to be eligible to properly use this travel hacking system. Now, one interesting thing about credit scores is that after a certain point, there isn't much benefit to having a really high score. If you have a score of above 750 or 760, you'll typically be getting the lowest interest rate on a mortgage. So if you're walking around with a score of 820, all those extra points aren't actually giving you much, except maybe that warm, fuzzy feeling inside, knowing that you're in the top 2% of credit scores in the country. Great. In a few minutes, we'll cover a walkthrough of how to check your score online securely for free. And if you haven't signed up for the course yet, you'll be able to see if this travel hacking system is available to you. Below the top two ranges is an average score. This is the most common range, and you probably have a few small or moderate things like missed payments or lack of history hurting your credit score. After that are bad scores and very bad scores. If you're in these ranges, especially if your score is below 600, you look pretty risky to creditors because you have some serious issues on your report. If you find your credit scores in a range below the top two, check out my full credit score course for more info and tips on how to boost it. Then head back here once you've gotten your score up. Now let's take a look at who's actually tracking your credit information and calculating your scores. And that's the credit bureaus. Credit bureaus, or credit reporting agencies, track your personal credit history. There are 3 of them: Equifax, TransUnion, and Experian. Every month, creditors, like banks and loan companies, report your credit information to the credit bureaus. Things like what your outstanding balances are and if you've been making your payments on time. Then, the credit bureaus calculate your score based on that information. Let's see how your score is actually calculated. Your score is made up of 5 components. The 2 largest are payment history and amounts owed, which make up 2/3 of your score. After that is length of credit history, new credit, and credit mix. Payment history. This is the biggest component of your score, and for good reason. It's the judge of whether you pay your bills. This component examines if you've been making your payments on time. The key metric here is missed or late payments. If you have these on your report, they'll hurt your score. By how much will be related to these factors here, like how late you were on those payments or how much was owed. The more on-time payments you have on your credit report, the better. The bottom line here is pay your bills on time. So that means not borrowing more than you can afford to pay back and being diligent about making payments. A good way to do that is to use automatic bill payment options for accounts you have. Opening up a new credit card doesn't have an immediate impact on this component of your score, but if you regularly put charges on that card, then pay off your full balance each month, that'll probably help your score since it's building good payment history and demonstrating reliability. Amounts owed. This is the second largest component, making up 30% of your score. The model here is basically looking at how much money you owe creditors, especially relative to your total borrowing limits. So that's the key metric here, credit utilization. It's expressed as a percentage. The formula is amounts owed divided by the credit limit. A high utilization, especially above 30%, has a negative impact on your score. The utilization calculation is applied at different levels to your personal credit. So the model looks at your overall utilization over all accounts within each specific account type and then individually by account, like for a single credit card. The bottom line for this component is to keep your balances low in comparison to your limits. In general, credit utilization below 30% is associated with good and excellent scores. One interesting thing here is that opening up new accounts, like a new credit card, can actually help this component of your score because you're increasing your total credit limits, which decreases your overall utilization. In this weird logic, lenders are probably thinking, well, this borrower has a lot of available credit. Other people are willing to lend to her. She must be reliable. Interesting. After amounts owed come the smaller components. First is credit history length at 15%. Here the model is looking at how long you've been building credit, with a longer history being better, because it shows consistency and reliability. This component looks at the ages of your accounts, including the single oldest account you have, which could be something like a student loan or a car loan you took out a while ago, or even your first credit card, the newest account, and the average age of all your accounts. Average age of accounts is the total combined years of history of all your accounts divided by the number of accounts you have. So if you have two accounts, one is 10 years old and one is brand new, so age of 0, your average account age is 5 years. 10 plus 0 divided by the two accounts. The next lower weighted area is new credit. This just looks at how much new account activity you have, mainly the number of new accounts and type of accounts. This also looks at hard credit inquiries. The thought process here is if you've recently opened 8 new credit cards, taken out an auto loan, and a new mortgage, you're looking a little bit risky. So new accounts opened and hard credit inquiries are negative factors for this component, and both cause a drop in your credit score. But their effects usually fade with time. So, if you've opened up a few credit accounts within the last year and nothing within the last 3 to 4 months, your score won't be affected too much by this component. It's also good to know that checking your own credit has no effect here or on your credit score at all. Checking your own credit involves a soft credit inquiry and is ignored for the score calculation, since it's not a risk factor. And the last component, credit mix. This component isn't really a big influence unless you're behind in other areas, like history length or number of payments made, or if you're lacking a specific type of common account, specifically a credit card. If you don't have a single credit card, then the credit mix component has a stronger weight, because in general, the score model views people who've never had a credit card as higher risk. So, if you have other types of accounts and you have pretty decent payment history, but don't have a credit card, and your score seems low, opening up a credit card may help you. Let's go over the takeaways for each component. For payment history, straightforward and common sense. Pay your bills on time, and you can use automatic bill pay services and reminders to help you do that. For amounts owed, you want to understand your credit utilization and make sure it's not too high. You'll build your credit history length over time. No big shortcuts here, except to start as soon as possible. In terms of new credit, don't open up 50 credit cards, take out 5 mortgages on your home, then finance a new Ferrari. But opening up a few accounts or credit cards a year won't have too much of a downward pull, especially since it helps boost some other areas of your score. And credit mix. This is the little guy. At the end of the day, this one's only a problem if you're lacking history in other areas, or don't really have many accounts open. How does this all tie into travel hacking? The method of opening up rewards credit cards obviously will impact your score. Now that you have a better understanding of how credit scores are calculated, let's look at that common myth surrounding opening new accounts and the effect on your credit score. The myth is one you've probably heard, that opening up new credit cards always hurts your credit score. This is actually false. It doesn't always hurt your score. Everyone's situation is different, but from my experience, and those of people I know, opening up a new account typically causes a short-term drop in your score, and then if you're managing your credit responsibly, mainly meaning making payments over time and keeping utilization low, your score recovers over the next few months. Why? Because opening up a new account actually has a positive impact on at least 2 components of your score, like we mentioned. First, you're increasing your total credit availability, which will drive down your overall utilization. You're also boosting your credit mix component by increasing the number of credit lines you have open and adding a credit card account. On top of that, you're charging things to your credit card, then paying off the balance. So you're also building payment history. On the downside, you have a hard inquiry and a new account opened, both of which negatively impact your score. But as we just saw, those fall within the new credit component, which only makes up 10% of your credit score. The newly opened account will also have somewhat of a negative impact on your credit history length, since it's decreasing the average age of your accounts, but the effect obviously diminishes over time as the account grows older. So those are the basic considerations between travel hacking and your credit score. In my personal experience, travel hacking with credit cards has caused ups and downs in my score, but in fact over the last year, when I earned a ton of points through using these methods, my score has actually risen 20 points to be above 800. I'll show you that in the next and final section of this credit score bootcamp, how to check your credit score online. Let's get to it.